and co-founder. My name is Heidi Pease. I'm head of investment products. And just a couple of housekeeping items. The presentation, David will speak for about 20 to 30 minutes. After the presentation, we will open it up to Q&A. So we would love any of your questions or comments. There is a Q&A button at the bottom of the screen, please, or the chat. Please post your question there, and I'll do my best at the end of the presentation to get to those questions. If for some reason after the presentation you want to reach out to us or you've got additional questions or comments, please send us an email to info@wavegp.com, info@wavegp.com. Quick introduction to Dave. So David has spent his entire career identifying transformative technologies and building successful enterprises, especially in venture capital and investment banking. Dave founded Wavemaker Partners, and he grew the firm to over 700 million in AUM across 300 investments globally. It was considered one of the top venture firms in Southern California. He has been he also founded a leading boutique technology-focused investment bank before selling it to CEC Capital. He's been investing in crypto since 2012. He's got a lot of crazy stories from that time and has become a highly sought expert in the space, though he's really quite humble about it. Under his leadership, Wave has grown into one of the top 100% crypto digital asset management firms in the space. And I can personally attest, it has been extremely exciting to be a part of his team here at Wave, where the company is growing at meteoric rates under David's guidance. With that said, I welcome David to the stage.
Thank you, Heidi. Hello, everyone. Thanks for the intro. I'm glad I have a non-humble people to be introducing me. So again, really excited to be here. We're going to talk a little bit about the state of the markets, probably a lot more about where we think the market is going, how we see all this unfolding. So this should be a good discussion. I'm kind of assuming people on this call are at a pretty basic level of understanding, meaning understand crypto, but maybe don't live it 24/7 like we do. Next slide. Next two slides. Oh, there we go. That's fine. So that's fine. You can start there. I'm going to really pretty quickly cover what happened, because I think if you are, watching the news ever, you have a pretty decent beat on some of the things that are going on right now. And it's not the most fun topic to talk about anyway, but I'll kind of cover it pretty quickly, but more in a sense of what that's going to mean for the future, like where things are going. A little less, chatting about just everything that's gone wrong, and almost everything's gone wrong that we thought could have gone wrong. So really quickly where we are, I'll just touch on a few of these things. So FTX and Alameda are obviously in the news as much as they possibly could be. I guess crypto awareness is an all-time high, though not in an awesome way. And having a lot of insight into what actually went wrong there. Sam Bankman's main advisor, Scaramucci, happens to be a good friend of ours, who kind of gave us the backstory. It's absolutely a disaster for crypto. It is as bad as it could possibly be. A lot of people call it our Madoff moment. In a dollar sense, it's way less than a Madoff moment. In a size of industry, in a size of, kind of a perception, it's massively worse than a Madoff moment. It may be worse than a Lehman moment. And just because FTX was the number 2 exchange by trade volume, at least, they didn't make a lot of money. But they were a huge heavyweight. Sam was, probably the most famous person in crypto, even though he didn't run the biggest exchange or the best exchange. He's the most outspoken person in crypto, to say the least. And so it's going to be a huge amount of effort to recover from it as an industry. Again, from a dollar standpoint, $8 to $10 billion isn't a big deal in finance, but relative to the entire crypto sphere, it's 10 times worse than what we saw with like a Madoff, or 100 times worse. So, and I think, and what people think that I spent a lot of time defending crypto, especially recently. And the one way I kind of look at it is, crypto's managed to go through pretty much everything that went wrong in the other financial markets and just do it in like a 5-year run. So we had ICOs in crypto in 2017, the stock market had the 1920s, stock craze bubble where everything went to crazy values. In relative numbers, ICOs raised like $12 billion. In today's dollars, those the 1920s raised $2 trillion and lost most of it, so a little worse, again, everything kind of has its moment. And if you look at what happened, again, with FTX, probably the most appropriate thing is Lehman. I mean, Lehman wasn't a fraud, but it was stupid. If you look at like a lot of the other things we had, DeFi summer and over incentivized, called DeFi yields and things like that, it looks a lot like the junk bond craze of the 80s, or maybe the saving and loan craze, so crypto is just going through a lot of growing pains. And it feels like we're at least getting through all those things pretty fast. I think we're at least up to like the 1990s, pretty quickly, and how things have gone wrong so far here. Hopefully there won't be, no 08 version of crypto or whatnot. Obviously, crypto exists because of 08. Anyway, so FTX is a mess. It's going to have huge ramifications, huge regulatory ramifications, which we'll talk about in depth a little bit later. DCG, which owns Grayscale and Genesis and a bunch of other things, is also adding to the fallout. It's a long story what's going on there. It might be one of the biggest cell phones in kind of financial history. DCG group, committed that they were backstopping Genesis. Genesis famously lost, $1.7 billion, mostly on the 3AC debacle back in June. He said that DCG took all the weight of that on, and cleansed everything off of Genesis's balance sheet, which made people were safe to trade with Genesis again. And then when it all blew up, he said that wasn't true. He never actually backstopped it, which this isn't reported in the press as much as it probably should be, but that's actually a really horrible thing to say. He's basically saying his broker-dealer, FINRA regulated, broker dealer was always undercapitalized for the last 7 months, and undercapitalized by like billions of dollars, which is absolutely a third rail for FinCEN and the SEC. Huge impact if you do that, personal impact, criminal impact, for knowingly running a broker-dealer, and with a huge deficit like that. So then, of course, he reversed again and said, no, but we just got to figure it out. But it's, at least that disaster in crypto is pretty solvable. He has Grayscale. Grayscale is worth a fortune. Last year, Grayscale threw off 650 million EBITDA. So it's a valuable asset. He's probably going to have to sell it to right the ship, but that's not the end of the world from a crypto sense. And then where we are in the space now, and I think I talked about this on a different update call back in June. So there's a few other, decent sized shoes to drop in crypto. So nothing on the order of magnitude we just saw with FTX and DCG, or 3AC, or Babel, or some other, or Celsius, and some of the other ones that imploded. But there are a bunch of others out there. So there's a bunch of mid-tier exchanges, particularly across Asia, that kind of took a page out of Voyager's playbook. So if you don't know, Voyager was a U.S. exchange that went bankrupt because of 3AC. They gave them $660 million. Wave itself has been, was a second high bidder to FTX, the last auction, bidding again. Long story short, they had a nice exchange business, but they couldn't scale very fast. They were kind of losing the battle to Coinbase. So they said, hey, look at what these, Celsius and BlockFi guys are doing. Those companies were originally lending platforms that kind of morphed into deposit platforms. So the business of Celsius primarily was, if you have cash, we'll pay you 12% to borrow your cash, and then we'll lend it out to really risky guys or do DeFi things with it that pay us more than 12%. And that's all great. And of course, they, in an arms race, kept doing riskier and riskier things. So Voyager got into that business, and that's easy. I can also put on the front of my website, I'll pay you 12% on cash, and we look pretty low risk as a public company. And it wasn't. They lost a bunch of the money, which put them in bankruptcy. But so did a whole bunch of other exchanges, mostly across Asia and South America, that also did the exact same thing. Now, Voyager, when they did that, and like BlockFi and whatnot, they immediately, they are highly regulated in U.S. companies. They had to put their hands up almost immediately and say, we're insolvent. And they went into orderly bankruptcies, and that's okay. I mean, they weren't criminals themselves. They were, not the sharpest, but they were not criminals. But but all the Asian exchanges that did the exact same thing, because you look at like any of the 100 or so Asian exchange or South American exchange websites, they all offered 10-12% on cash during that period as well. And the only way to get that money was to do the same thing everyone else was doing, loaning it to miners, loaning it to hedge funds that were taking directional bets, and they all blew up. So now the challenge right now we see is say you lose 20% of your client assets like Voyager. Well, if you want to hide it until there's a bank run of 80% of your assets, not that hard to hide. You just don't tell anybody, and you can kind of fake it for a long time. This is exactly what Mt. Gox did in 2013 and 2014. They, had a bunch of Bitcoin stolen, but instead of telling anybody, they just said, okay, they raised their transaction fees. They were trying to make it back. And eventually they got caught because there was a bank run. People started to look on chain and figure it out. So our expectation is there are a whole bunch of other, some of them even top 10 exchanges that are probably, functionally insolvent as well. And that's, and we're just kind of sitting around waiting to see when they blow up. But cumulatively, they're a fraction the size of like an FTX Alameda. So from a market damage standpoint, more bad press, more regulators getting upset, but probably not the financial impact we just saw. So anyways, that's kind of a general state of where we are. And then I'll talk about the regulatory side also. I'm sorry, my throat's a little sore. So the regulatory environment is, I'm being a little more negative than I would like to be on these calls, but it's pretty awful. So and it's global. I mean, the U.S. regulatory environment has been lousy for crypto for a good long while. But now we're seeing everywhere: Singapore, South Korea, Japan, EU, UK, like pretty much every major jurisdiction in the first world has also turned, completely sour on crypto, and they're going to do a bunch of things that are not going to be helpful to the space. The big one they're looking at doing is focusing on stablecoins, because that's probably the first thing they understand and want to go after. And the changes are going to be pretty lousy for decentralized finance. So the main thrust, and we hope it doesn't happen, but it looks like it probably will, starting with the US, is they're going to say anyone that touches first of all, stablecoins have to be regulated, like USDC basically is. But once it's regulated, the issuing institution and any institutions touching it have full responsibility for all things around, solicitation, OFAC, on and on. OFAC is a scary one. So the reason Tether and USDC exist mostly is DeFi, or financing mining operations in China or Kazakhstan or whatever. And they don't have, those places don't have good access to U.S. currency, and everything is purchased or sold in U.S. currency, effectively. So they wanted a U.S. currency equivalent that could work in a nice crypto world. That was the origin story of Tether. I was their first investor in Tether back in 2013. It's a really simple business, really good business. But from a regulatory standpoint, obviously can be used to facilitate, a lot of bad things, and some of those aren't like bad things. A student in Iran, that wants to play in crypto could buy USDC and hold it, and that's a pretty serious OFAC violation. So what they're going to do is basically make the institutions be responsible for not allowing any of that to happen. And that's in a crypto world, that's almost impossible. That basically means that those stable coins really can kind of barely exist, or they just have to stay entirely outside the US first. But we're actually seeing this everywhere. I mean, US will be first, but within a year, I think we'll see, something similar out of like Singapore, out of EU. And that's going to make a lot of challenges for decentralized finance. Again, decentralized finance is effectively cash-based. Most of the trades are against a US dollar equivalent. So that's bad. And, so it's going to add a lot more challenges. We'll see a lot more of crypto shift to what are called algorithmic stablecoins. So algo stablecoins are ones that are not dollar reserved, like with dollars in a FDIC bank account. They're using a basket of assets, usually, mostly Bitcoin and Ethereum, with high over collateralization and a bunch of machinations around liquidations. But they give you a dollar peg asset. It's just not as good as like a USDC. So they work. They're very functional. There haven't been a lot of breaches there outside of Terra, which was its own disaster. But anyway, this is the last of the negative things. I'll be more positive after this, but that's what we're seeing right now. And, obviously the environment is bad. Senator Warren in the US is, just proposed a whole bunch of draconian legislation for crypto, but it also affects all finance. Our US government seems really, adamant that if anyone moves as much as $600, they need full accounting of it, despite the fact that the government can't balance its own books. And I'm trying to add a lot of surveillance, and obviously China's figured out how to add ungodly surveillance to their, government-backed, stablecoin, GBDC, and a whole bunch of others. So we're negative headwinds for us for sure. Next slide. So, okay, now take a minute here. So here we're going to jump into what we're actually excited about and what we think the future of crypto is, and kind of where all this goes. So we'll start with, probably one of the most exciting areas going forward, which is, how do we make crypto something that consumers experience, every day, all day? And obviously people kind of refer to this as, kind of the internet moment, or if you were, as a VC back in '95, the Netscape moment. That was the moment when the internet went from like white text on a black screen, to what the internet looks like today, images and video, and eventually streaming media and social media and all those kind of things. And that's kind of where, that's entirely what we see the NFTs and kind of Web3, portion of blockchain being. It is that moment. People like Bitcoin, people like speculating on financial assets. But no one, you don't exactly, everyone has a mortgage too, mostly, but like, you don't really experience your mortgage every day. It's a financial product that's important because you need it for what you want to do. But it's not exactly part of your daily life. NFTs are different. So I think it's written here, but the stat I love most, which has been published a lot now, is there are 480 million humans in the world that spend more than 35 hours a week playing video games. Obviously, the average person globally, I think, spends like 2.5 hours a day watching TV. Like, people really care about media and entertainment. That is, most of people's lives, fortunately or unfortunately for a lot of people. And the game one is pretty compelling statistic in a sense for crypto. So, if you look at the gaming sector right now, it's $150 billion a year. It's a big sector. And it's, it's the fastest growing sector. It's massively dwarfs, film. It dwarfs TV now. It dwarfs a lot of things. Radio, music, everything, almost all combined at this point. So people love games. They spend a lot of money on games. Games have shifted a lot to microtransactions. And what most of those microtransactions are is people buying items in games, downloadable content. If you want to play a sword fighting game and you want to go to the next level, you spend $5 to buy a better sword or a better gun or whatever it is. And you can, and then you can advance faster through that game. And that's the majority of that $150 billion a year. It's a lot of money spent. The flaw in it, if you're not the game company, is, you spend, a lot of people spend, $100 a month on video games or more, and all of it's throwaway. When you're done playing that mobile game or whatever you bought in that game, and you get sick of it after 6 months, which is the average life cycle of a user using a game, you basically throw it all away. And the promise of Web3 for the GameFi sector is, why throw it all away? If there's a trade-off from the company that's selling it, but if you are playing games and you're buying swords and you're advancing your characters, other people are going to play that game after you. Why can't you sell it to them? Sell the swords, sell the character, sell the armor, sell the skins, the colorful stuff. Why not be able to sell that to the next person and either make money on the game, or at least get your money mostly out of the game? And that's the premise of GameFi, largely. So, and why we're mostly excited about it isn't because, and this will be the absolute dominant use case. Like, we've already seen this, through pretty hard evidence. Like, once consumers get used to persistent goods in games, if they can spend $100 in a game and even get like $50 out, they will never go back to the old model. Because why would you? It's a massively better model for consumers to be able to do it that way. And it's more fun, and they can actually, and then it becomes a real game in a newer sense. They can actually, if they're smart at buying things, if they're good at playing the game, if they can experience up their character and whatnot, they can actually be paid for playing the game, because someone, that's richer and lazier will come along and want to jump ahead, and great. But the other side of that is, and we're already seeing this in really dramatic fashion, instead of being willing to only pay $5 for a sword in that game, maybe you're willing to pay $500 or $50, or you pay much more if you knew you could sell it. I mean, if it wasn't a throwaway purchase, a disposable purchase, it was a investment purchase. Like, people get way more excited. People think they're good investors. Never meet a gambler that loses. Kind of mentality. People like this. People love thinking they can make the right choices. But when we're seeing in NFT land in particular on these kind of games, and they're in very early stages where they're emerging, is people spend tons of money. People are spending thousands of dollars buying goods and actively trading them. They're buying a sword, they're finding out it was a good sword, it had a good attribute that was rare or something like that, and they can sell it for a profit. They sell it, they buy other cheaper swords, and they try to make them better. And and you see this incredible economy emerge. But it's actually awesome for the game company. The one pushback I used to get from a lot of the game executives out there, we know a lot, is that, oh, well, if we let people resell all this stuff, how are we going to make as much money? And we never get that pushback now, because they realize they can make so much more money. Yes, you could sell a $5 sword, to 500,000 people or something. That's great. Or you can sell a $500 sword to 10,000 people, and you make more money. And you can, some bad math, but you get the idea. Like, you can, and you're still selling. Every item you sell, you just sell for so much more money. 10x, 100x the amount of money you could sell originally, because these things are more unique. They're more, and there's a resale market, because people know that if they buy it smart, they can get out of it. So we think this is just going to be a massive transformation of the entire game industry. Like, literally every piece of it. It'll change the Xboxes, it'll change everything. There's a reason why Microsoft and a bunch of others have been huge investors in the Web3 gaming space, the crypto portion of the space. This is the future, and everybody kind of sees it now. And I actually believe, like, that sector alone, could, all of Web3. And then there's NFTs, there's music NFTs, there's video NFTs. NFTs are just non-fungible tokens, so unique tokens. I can easily see that sector rivaling, literally rivaling the value of the entire non-NFT crypto sector. Just because people experience it every day. And the more powerful thing is, as people experience this stuff every day, is where you see people, you'll see wallet structures improve. It'll be easier. Every game is going to have a crypto wallet embedded in it. And that's going to be a huge launch pad for the future. So once people as the wallets get better, the user experience gets much better, and people are, trained that these are blockchain assets, they're educated. That they now are, people that never would have thought about buying a Bitcoin, but they're into video games, will suddenly have a crypto wallet. And as they get more into other stuff, that crypto wallet can hold, the game icons, game units. You can hold the layer one that those games come with. You can basically buy stock in, World of Warcraft or whatever the equivalent is that's coming out, in a tokenized form. And then you can also buy all the rest of your crypto. And it kind of forces, I think, billions of people to realize that crypto is safe and stable and immutable, and all those kind of fun things. So we can go to the next slide. And okay, so that's, I'll pause on NFTs. I'll probably get a lot of questions there, as I usually do. So going back to DeFi, I talked about a lot of the headwinds we're going to see from regulation, but there's also just a massive amount of promise. So I didn't put it here, I don't think. So one of the biggest promises we see is, I don't fully understand why the governments are all doing this, but every major government in the world, China's already launched theirs, are launching these government-backed blockchain coins, CBDCs. And they are all, they're basically, and the amazing thing is, from a crypto bull standpoint, is they're literally training their population. China's training its population that a cryptified, blockchain-enabled digital currency is actually superior to the existing currency, which is an incredible thing. And we're already seeing this in China, and we're seeing it in Lithuania and a lot of other countries where these have launched, is you see crypto adoption just rocket up, because now every wallet is a crypto wallet. If you can hold, the government blockchain dollar, you can hold anything, because it's all the same pipes, it's all the same thesis. You need all the same kind of wallet structures and everything else. Obviously, it's simplified. But the governments of the world are doing this. One are saying how much they hate crypto and how risky it is and how scary it is, and people shouldn't be that engaged in it. And then at the same time, they're simultaneously teaching them that they should be really excited about this new currency. Now, why China is doing this is kind of twofold. One is it becomes a surveillance coin. I mean, no one in China actually wants this government coin. Because it's the exact same money they already had. I mean, everything in China is digital. You almost never touch paper currency inside China. They have AntPay and Alipay and really good digital money systems already built. So no one wanted this, but it does give. So the main benefit to the government is it gives them massively higher surveillance. And the second thing it did for China, in particular, but this is part of a lot of particularly like third world countries, is it disintermediates all the other financial players. So long story short, everyone I think saw what happened to Jack Ma a few years ago. With Alipay, he got a little too powerful. I mean, Alipay actually kind of became a central bank. When you're 50% of all transaction volume in a country the size of China, you actually are setting monetary policy, you can fractional reserve. And, they saw that just as him taking too much power. Or having, potentially having way too much power. So he disappeared for a year, which, that's only China do. Well, not only China and other countries do those kind of things. But they also completely hamstrung it and forced him to use their version of money and basically forced him to turn all the pipes over to their government coin. And we're seeing that in a bunch of other countries, in Dubai and UAE. We're seeing it in like Turkey and places where they, probably don't have the friendliest rulers. But it's a way to take incredible power over their currency. So that's why they're doing it, but the benefit to crypto is also still enormous. So that's kind of one interesting tailwind that'll take a few years to play out, but I think it's a much under discussed and massive tailwind that'll be pretty transformative for crypto in general. And that actually leads to DeFi. So yes, the government's going to make it really hard to use things like USDC. Or Tether or some other stable coins, EU coins, but they're also forcing everybody to use an equivalent of it. Slowly force them over time to create better stable coins that are perfect. I mean, they're government issued. They are absolutely riskless, whereas obviously Tether and some of the ones have a lot of risk, or a lot of risk compared to a riskless token, say it that way. And it's just going to supercharge all aspects of DeFi once we get past this giant hump. So. And what we're seeing in DeFi has been pretty incredible. And again, I think there's going to be a scary period when a lot of these regulations come out. But we're just seeing these explosions in DeFi now that, everyone is a little bit paranoid of CeFi. And backing up for 1 second, I tend to go long in these presentations and get through slides eventually to get to questions. What we're seeing in CeFi is obviously kind of a disaster. Some of the most trusted names in all of centralized crypto have now imploded. Celsius was the biggest lender at 26 billion. FTX was the second largest exchange globally. On and on. We're seeing a lot of damage. So what we're seeing is a huge shift to decentralized finance. So most of the things you can do in a centralized exchange, you can actually do if you're a little bit technical in a decentralized exchange. And we're slowly getting rid of the little bit technical part, meaning it's getting easier and easier. The wallets are getting better. The UIs are getting better. But there's, for most people, I mean, you still need to have a fiat rail to get crypto assets in the first place. So you'll always need an exchange, a Coinbase to put in dollars and get a stable coin or Bitcoin or whatever. But from there, it's actually, relatively easy for people like us. I mean, our traders use DeFi exchanges more than they use CeFi exchanges now. It's easier, it's cheaper and faster in a lot of ways and lower fee to do all of your trading in a decentralized world. So decentralized exchanges are, they're kind of they're function fundamentally a lot like centralized exchanges, a little bit different machinations. But because they're truly decentralized, all they are is software put out in the wild, and it's controlled by their governance token for voting and upgrades and things like that. They're incredibly low fee. And some of them are actually kind of negative fees. They also give out incentives. So we're seeing a huge switch to that part of the world. To that decentralized finance, because it works, and through all these disasters, nothing in DeFi is fundamentally broken. I mean, there's been a few exploits, but really, an exploit means that someone goes in and finds a software bug and is able to extract the tokens, the Bitcoin or whatever that is in a smart contract on these decentralized exchanges, and basically steal users' money. So that has happened, but it has never happened on the largest exchanges. the largest ones being like Uniswap and SushiSwap, and the largest lending platforms in crypto. You can deposit assets and borrow against it. In lending case, you don't want to sell your Ethereum, but you want to buy a house. We do this for clients. You can deposit Ethereum. There's a margin call, so you have to over collateralize it. You can then borrow cash and go buy a house. So the major platforms have actually never broken. So where you have had a few $1 billion of exploits in total is on emerging, very nascent platforms that uniformly offer these like massive incentives to try to scale growth, but their software code wasn't baked enough and they had problems. But overall, DeFi has been pretty flawless when you look at it in the large scheme of things. And during all these gyrations we've seen that were pretty awful and super high volatility, when Terra and 3AC blew up in June and July, or May and June, and when FTX just blew up, DeFi had no problems. There were some liquidations of people. That's how they work. If you put money into a lending protocol that you're over collateralized and your collateral drops in value, you can be liquidated. But that's how banks work too, or pawn shops or whatever. It's the same concept. So everything's been relatively flawless. So we're seeing a huge shift there. And the most important part, especially for like Wave's businesses, the sophistication of what you can do in DeFi has also gotten massively better. So not just do we have spot exchanges and simple lending vehicles, we have all sorts of derivative platforms, option platforms, futures, perpetuals, all the basic financial building blocks that we've used for 50 years in traditional finance. We have now, it's harder to do those things in spot exchanges, but they've now found their way into decentralized platforms. More and more you can pretty much do really anything, even pretty advanced finance strategies in a truly decentralized world, and it's way cheaper, it's way safer than CeFi has proven to be. And so that's a huge part of the future, and that's obviously where Wave focuses most of our efforts. And we go to the next slide, I guess. And I'll give a little bit of commercial on Wave. I think we're almost done. So, the origin story of Wave pretty simply was, and Heidi kind of alluded a little bit to this, is, when we were getting ready to launch the company, myself and other founders, had a couple hundred different tokens, and looking around the world for someone to kind of manage those assets. And there wasn't anyone. I mean, there were lots of, probably 50 asset managers in crypto at that time. This is like late 17. But they were all, more like Vanguard style asset managers. So in our industry, that's like Grayscale and Bitwise and CoinShares and, good companies, not taking away any of those companies, but but all they offered was like single token long funds. They didn't, and not very many of them at the time. Like if you wanted a place to put your Bitcoin in a high fee, vehicle, great. Grayscale had a vehicle, they charge you 2.5% a year and they hold your Bitcoin. That wasn't any of our challenges, and that certainly wasn't our clients' challenges either. A lot of our clients were literally Bitcoin inventors, Ethereum co-founders. What we all wanted was someone to handle kind of everything else and then actually put it to work. So that's what we found a way to do. Our early clients were some of the early, kind of crypto whales, we call it. Those are our version of crypto high net worths. We now manage assets for a lot of very large protocols, a lot of miners, some exchanges, and all in DeFi, almost entirely in yield strategies. So Wave has basically two businesses. One side is exactly what you would expect: separate managed accounts, no commingling of assets. Obviously, kind of the antithesis, our space of like a BlockFi or Celsius. Perfectly clear reporting of exactly where our clients' assets are every month. People call our relationship managers and say, I want to come out of this token and go into this token, and we handle everything for them as part of a package service. And mostly what we do is we generate yield for those clients. So we put the assets to work. We stake where appropriate at the very low end. We do all aspects of like stablecoin yield farming, market neutral yield strategies, all sorts of derivative strategies. If they want to get into a position or get out of a position, derivatives are kind of an interesting way to do it. So it's a lot of like, we call it targeted acquisition strategies. The other side of our business is our asset management arm. We have 10 funds now, 3 early stage venture funds, 4 structured products that are mostly yield products around crypto. Things like, covered call strategies on Bitcoin or kind of market neutral yield strategies. And a couple of alpha seeking funds from a company we acquired a few months ago in Geneva, called Kryptonite. All right, so that's kind of Wave's business in a nutshell, and how we approach this market has been pretty successful. I think you go to the next slide. Yeah, there we go. So, and what we really offer to our clients first and foremost is risk mitigation, which is probably the most important thing now. So, not to toot our own horn too much, but we've navigated all these periods recently with absolutely zero damage. So we had money in UST Terra, which was the first kind of domino that fell back in May. And we managed to get all the money out for our clients with no losses because we know how to monitor liquidity pools. We know when there's smoke, there's probably fire, and we pulled all the assets out early. Same with other counterparties that blew up along the way. We did have assets on FTX for clients, a week or two before it actually imploded, but we knew what was going on or started to hear what was going on, long before there was a real problem, and got all the assets out. And being a pretty sizable, one of the largest, the largest wealth and treasury platform in crypto, we have a very active and experienced risk team with a lot of 20-year traditional structured products guys, bankers, risk controllers that know how to do this and bring kind of proper rigor and really understand this. So even though we operate in the Wild West and we've seen massive failures all around us, we're really happy to say we've never lost a penny of client assets. So the next slide. And yeah, and I think I already kind of answered this slide, so I tend to go ahead of my slides. So yeah, so again, any questions for us? I'll turn it back over to Heidi to kind of navigate. And thank you everyone for listening to me ramble for 30 minutes.
Great. Thank you so much, Dave, on that very insightful presentation. Were you going to mention anything? Well, actually, I'll just jump right into the questions. We've got a lot of questions that came in from the audience. Again, if you do have something, please feel free to plop it into the Q&A or to the chat. Well, let's go ahead and get started. You focused a lot on DeFi, and so I've got a couple of questions on that particular topic. First one that came in is, how is Wave thinking about real world asset DeFi lending protocols?
RealFi. So RealFi is not exactly a term yet. we're trying to make it one. So what we mean by RealFi is actually mostly regulated DeFi. So right now, and Wave is a regulated company, so we think we're well positioned and kind of thoughtful on how this should look in the future. So regulated DeFi, and there's other ones that have kind of launched, but they're pretty nascent so far, like Aave Arc and Compound Pro. It basically means exactly all the things I mentioned in DeFi. You have decentralized exchanges, decentralized derivatives and futures markets, decentralized lending platforms. But it's all regulated, meaning on both sides, you have full AML KYC. For a lot of the strategies, it needs to be fully accredited investors at least on the supply side, on the kind of more retailish side. And then you have, on the other side, you have pretty much facing off only against institutions, or it can be other individuals, but again, fully regulated. Everyone is known, everyone's shown the photo of their passport. You solve all of the, kind of low end retail issues. You solve all of the OFAC issues and whatnot. And obviously we believe that is the future, not that we want that to necessarily be the future. I mean, it's good for Wave because that's our business, but it's going to be the future anyway, because that's where the regulation is going. There's not going to be ways for a US or EU or whatever, first world asset manager in crypto to not do things in a regulated way. At least not without risking taking systemic risks. So all the principles are identical. Right now it's a little bit more nascent. It's Wave itself is actually in the process of building out a regulated platform. First with one of our protocol partners, and the good thing about that is they're a really rich protocol partner, so they're going to shovel a bunch of money into it, which is great because they're going to put a lot of cash in, which will drive down yields, which is good for the other side. The borrowers will get good deals if they are willing to do the AML KYC, which people are. Most good people aren't terrified of AML KYC, so it's not that big a deal. You don't limit the audience that much. But I do think that is the future. And I think the world will pretty quickly bifurcate, and I mean quickly in the next 6 to 9 months, that you will have a regulated world for DeFi, decentralized finance, and you will have an unregulated Wild West, which will probably remain, risky, probably a little bit scammy here and there. And that unregulated world will be, people VPNing out of China and, people in, more third world places that don't have a lot of regulations or haven't gone forward on this. And the first world will live in a regulated world. And, again, so that we think that's likely the future.
So David, thanks on that. I think the question actually mentioned real world asset DeFi lending protocols.
Oh,
But before you jump into that, you were mentioning regulated DeFi, and there was another question that came in regards to that. Is Wave in a unique position to accommodate the new regulations since you are already SEC registered?
yeah, we're actually happy. I mean, this was what Wave was built for. We went regulated route day one and made huge sacrifices to do that. I mean, like really huge. Like we, all the things, all the companies around us were doing, like we do the same things in a good way. I'll say this as like a Celsius, but we didn't want to touch retail. They went from 1 billion to 26 billion in 9 months, assets on platform. By not doing AML KYC, not working with the accredited investors, the strategies they were doing, the yields they were paying out, pretty much the same as us. We kind of took the steady and slow route. And then obviously Celsius got sued by the SEC, by EU, by a whole bunch of others. And then before they could lose those lawsuits, which they would have, they managed to blow themselves up entirely and wiped out like $5 billion by just mismanagement and poor risk controls. So, it was right that the SEC was going after them. Your retail investors should not have been on that platform, but we made the hard choice of doing it the right way, and so that now we're getting the reward for that. And the other side of that reward is, tooting our own horn a little bit, but every one of our major competitors, like we directly competed with Alameda and Genesis, slash GCG and a whole bunch of other companies that are all gone. Like all of our competitors managed to blow themselves out. So yeah, we probably could have been a multi-billion-dollar company. We're a multi-billion AUM company, but we could have been like a many billion-dollar, parent company had we gone the Wild West route like all of our peers did. And we didn't, and now we think we'll be a multi-billion-dollar company again, pretty soon, because we're the last one standing. They're all gone.
Great. So then let's go back to that original question, which is how is Wave thinking about real world asset DeFi lending protocols?
So I don't exactly know what that means. I mean, I'm not sure what that means. I mean, DeFi and real world assets a little bit hard. So how DeFi mostly works is everything is digital. So obviously, I assume what that question means is you're taking a digital representation of something and taking it into DeFi. That something could be basically like a certificate of ownership to a Picasso painting, if you want to put it like in an NFT world. And then that asset can be bought, sold, theoretically fractionalized, though not in the first world, whatever in a DeFi world, or used as collateral or something. I think we're pretty far away from that because the whole point of crypto is not having to trust anybody. That's the underlying premise of why Bitcoin was started and DeFi and everything else. And the beautiful thing about DeFi is I can do transactions against people I'll never know and don't never need to know. And I can do it in the absence of trust, meaning everything is in a smart contract, everything is in code, it's rule-based. There's no way for that person to violate outside of a software exploit, but those are very rare. So when you start adding real assets like a building or gold or something like that, you kind of start breaking a lot of that trust. Like, okay, like, is the gold really there? How do you know the guy didn't create the certificate of deposit and then sell the gold to somebody else? In a crypto world, you can't do that. You can lock the asset, say it's Bitcoin, in a contract, and you know where it is. It sits on the platform. It's on chain. Everybody in the world can go look at it and verify it if you can read a block explorer. So when you start blending in real world assets, I think it gets very, very challenging. And I don't think DeFi is ready for that, or the crypto world is ready for that. And the other simple answer is most real world assets don't have crypto return potential. Like there is tokenized gold, Paxos Gold and a couple other ones, and they've never had any success because, quite frankly, gold doesn't really change in value a whole lot. It's kind of closer to a stable coin in some ways, or I guess you call it an inflation hedge, but it's been a terrible inflation hedge this cycle. So why would anybody want to go buy it? And most people are in crypto today because they're looking for outsized returns. They want those 10 or 100 X's. You're not going to get that from a real estate building. You're going to get 3% a year, or maybe with inflation now, maybe 10% a year. But you're not going to see those kind of return profiles. But it's also, you need a lot of infrastructure, and you need a lot of trusted intermediaries to exist. So if it's gold, you need someone at a bank with a vault that's going to continually attest. Basically you can ping them 24/7 to say that the asset is available. and it is still there and is unencumbered and and then you would actually be able to trust it, but you have to trust the bank, which we'll get to for sure, but I don't know if that's where the world is quite yet in crypto.
So David, thanks. Just so you know, for time management's sake, we've received about 30 questions.
Oh,
I'm going to do my best to get through them. I've got 2 more questions on DeFi, and then we'll quickly go through the rest. Continuing on DeFi, is there potential fraud risk in DeFi?
Not really. I mean, again, it's all on chain, it's all in code. I mean, most people can't read the code, but we can. But so when you say fraud risk, it depends what the fraud you mean is. So could you accept collateral and that to borrow that and let someone borrow your cash against collateral and that collateral is bad? I mean, the tokens have to be real. I mean, all this is on chain, everything pins the contract address, so you can't make up a new version of Bitcoin and deposit it, because it would check before the deposit cleared with the Bitcoin network, and it would verify that this is in fact real Bitcoin, that was the wallet that owned it. Here it is. So there's no way to fake that. Period. I mean, that's the whole premise. Our whole industry is built on that single premise that you can't easily fake assets, or say you own something you don't own, unlike kind of traditional worlds. So I don't know what you mean by fraud. I mean, the biggest fraud we've seen in crypto and DeFi, and I shouldn't say biggest because it hasn't been that frequent, is people create a new protocol that's a fraud, meaning they're intending to steal the money. So they create a new lending protocol, they get people to deposit assets onto it, they promise them these big financial incentives to do so, and then they built a backdoor in, they take all the money and leave. So that has happened. Again, on the relative scale of DeFi. There was $500 billion of assets in DeFi at one point in time. There's been, maybe $1 billion of that total, across, maybe 20 or 30 bad projects, criminal projects. But in the big scheme of things, it's not a lot of money. I mean, it's, 1/500th. So, and only people that got ripped off were people that were really, really greedy, meaning they were going into a brand new platform that they probably never heard of because they were getting promised, 100% APY, and then they lost it. So don't do that. If it sounds too good to be true, it probably is, but this is retail and crypto. But yeah, I don't know. I'm not sure how to answer it any other way.
Well, we've got just one other question on DeFi, but it is a mouthful. So what do you make of the criticism of DeFi that the vast majority of loans go to crypto speculators rather than tangible value generators? Is this critique fair? Will we see this change as a response to the recent crisis? Or is there a long way to go before DeFi borrowers look more like TradFi borrowers?
Yeah, I mean, there's a lot of ways to answer that. So first part, it does already look like TradFi. I mean, I don't know what this asker thinks TradFi borrowing looks like, but it's hedge funds, it's people taking huge risk. They do blow up occasionally. They have margin, they have capital calls, but they're doing pretty risky. But again, a lot of TradFi is people trying to eke out pennies here and there. Like a huge portion of TradFi is people eking out a little bit of money, and half the time are being retail or whatever. So DeFi didn't invent that. And yes, most of the DeFi borrowers are going to speculate, but who cares? It's like saying, people that borrow money to buy a second home as an investment property are doing the same thing. They're putting down some collateral, they're taking a levered bet, and sometimes that levered bet works, sometimes the bank gets it back. It's the exact same thing. So from a DeFi platform standpoint, I don't care. We have clients that do this, we do it for them as part of our business. They have an asset, say like Ethereum or Bitcoin, they have a lot of it and they think the market's going to rise. So they want to get leverage on it. And okay, so we can deposit those assets for them. We can give them cash that, they can use that, deposit Bitcoin, they can use that cash. They borrow, buy more Bitcoin. Obviously there's margin levels. So, if they're wrong, they're badly wrong. If Bitcoin goes down like 30% and they're a little bit levered, they can get their position wiped out. But the DeFi works. That's what's supposed to happen. That's what happens when you make a bad bet on a speculative asset investment, any asset class. If you take leverage and make a bad bet, they take their margin. And the guy that had the margin system, the bank in that example, is perfectly fine. They did nothing wrong. They gave you a loan, it had certain terms in it, and when those terms were breached, they took it back. That's what DeFi is. So yes, most of DeFi lending is fueling a lot of speculation, or it was. right now, there's not a lot of speculation. The futures and whatever markets are pretty depressed, quite frankly, after everything that's gone on. And so a lot of those people that were levered long, most famously like 3AC and Alameda and other groups, managed to completely blow themselves up. So there's a lot less of that liquidity out there right now. But when you say tangible generators, I mean, so the platforms themselves are tangible generators of value. Like those are really, Aves and Uniswaps, I think are incredibly valuable. I think they'll be incredibly valuable. Maybe they'll get replaced by somebody else, but that thesis will be $100 billion, $500 billion, sector in a few years, as I think more and more of the world goes towards crypto. When you say tangible value, I think usually when I hear the tangible value argument in crypto, it's like, okay, we've got 2,000 layer ones, they all process a bunch of stuff, but all that stuff they do is just processing other speculators. And that's obviously very true today. We're relatively early goings. If you put us into like an internet parlance, which probably is still like 95, 96, things are early. That was way before we had things like, video streaming and social networks and Uber and, online banking even really didn't exist back then. Online stock trading didn't exist then. We're still kind of at that level. So that's where all the value is going to come. And that's the premise of Web3. We talk about NFTs, talk about a lot of other things that I think are adding more value. It could be entertainment value, it could be collectible value, it could be, new ways to trade assets better, the more modern versions of like an E-Trade or Schwab account that has more assets, more flexibility, more tools, more margin abilities, more derivative abilities. Like all of that will come over time and add a lot of value. It's pretty early. So, we're just early, for sure, we are strong believers, to say the least, dedicated my financial life to this asset class. So, all of it is coming and it's coming pretty quickly. Again, you look at most of crypto is finance today. You look at the finance world, and it's a 200-year-old world. When banks started writing notes as the earliest versions of kind of currencies in the 1800s, and when we've come a long way in 5 years. But I mean, I'll say it this way: I was a tech geek. Still am, but was also. And I was playing on like the E-Trades in like 95 when it first launched, 95, 96, maybe 96 when it first launched. And it was a horrible experience and no one used it. It was awful. The UI was terrible. It seized up all the time. You had to download the software. It wasn't online really. It's kind of online. It connected to the internet, but it wasn't like a nice browser experience or whatever. And even like 3 or 4 years later, I was still using it. Still crap. Still an awful experience. Compared to what a real stockbroker got to look at, and then it got good, and it took a long time, and it took, anyway, so it does take a long time, and DeFi has really only existed since 2020. It hasn't been a very long time, and we've built a lot, and it's getting better. The user experiences are still awful. It's still hard to use. It's scary to use. You can make mistakes and send your tokens to a wrong wallet address, and they're gone forever. So there's ways to go, and there needs to be a lot more handrails as it goes more retail. But it's been a couple of years. Give it 5 years, and I think it'll rival anything.
Great, thanks, David. So we've got about 6 minutes left, and still probably 25 questions. I'm going to just hit a couple. We've got some for Wave, a couple on venture, and a couple on NFTs. So let me just start off with the Wave question. You mentioned there is no meaningful exposure to FTX, but what is no meaningful in terms of percentage exposure on your different Wave strategies?
Zero. It was actually, I don't know if I said no meaningful, but anyway, we had some, I think I said we had some minor amount of assets there with Alameda and with LedgerX, mostly the US entity. And then we started getting nervous. We started seeing the tea leaves, a couple months ago, but then we got really nervous in a couple of weeks before it all imploded. So we pulled all of our assets back. So we ended up with zero exposure, not one penny, just to be clear.
Great. And while we're talking about FTX, are you making another run at Voyager with FTX falling out? What is the future growth goal of the company? And is Wave buying any new distressed crypto assets?
So yes to all. I can't talk about Voyager because we already got a really mean letter from them for talking about Voyager once in this process. So can't say a whole lot, but we are putting together something right now in the next few days. And yeah, for Wave itself, I'm an old M&A banker and was a kind of a private equity guy for a minute. And so we're super excited in this period. We have a great balance sheet. We have a good team. We're actually, the first time crypto winter we went through, which was right when we launched the company, 2018. We were completely on defense. That was not fun. We survived, but that was about what we did. This time we actually are set up to take advantage of this. So we have bid on 2 companies last week. I mentioned we completed 1 acquisition a few months ago, which is also pretty distressed. We are not distressed like bankruptcy, but just running out of money. And there's probably 3 others we're leaning towards probably making offers for. And things are really cheap in crypto. there aren't a lot of other buyers in crypto asset management right now. I mean, the behemoths were Grayscale / DCG was one behemoth. They're gone, effectively not dead, but they're not doing well. CoinShares was the second largest in the space. They lost all of their money on FTX. Not their client money, but all of their money. It's publicly announced they lost $31 million, which was their entire cash balance to Alameda. So they're not buying anything right now, and they're actually in serious trouble. All the other ones that are out there, there's just really not much else in our space anymore that's surviving. Obviously the big ones were, the big ones we would have thought we'd be competing with for these assets today was FTX, Alameda. It was 3AC out of Singapore. It was Celsius and BlockFi. They were very acquisitive until they blew up 6 months ago. Voyager, I think Celsius bought 11 companies. Voyager bought 5 companies until it blew up. All the obvious buyers for kind of crypto financial assets. There's pretty much us and Binance left. And Coinbase should be a buyer and they should be buying things. And they're absolutely doing nothing. They're dealing with the SEC issues. They're bleeding massive cash. They laid off 40% of their employees, including their BD department. Almost their entire BD group they let go as they're just trying to hunker down and get through the winter. So there's really no buyers out there. So, a couple of deals we're making offers on, we're literally offering them 0 and a teeny bit of stock. And we're going to get it because it's either that or they turn the lights off. It's really just, it's acqui-hires. We're giving them jobs.
So speaking about Binance, is Binance at risk of going the same way as FTX?
God, I hope not. And I don't think so. So I was, if it does happen, crypto is really hurt for a long time because there's $80 billion sitting on Binance that they could take with them. That is a lot, including a ton of Tether receipts. The Tether money sits in a bank. But anyway, so there's all sorts of problems if Binance goes out. I was actually with CZ in Abu Dhabi at the Milken Summit just recently. Had drinks with them 2 nights in a row. And I know well. I don't think there's any real risk with Binance. And Binance was not FTX. What FTX got in trouble for mostly is they pitched their business as they were the first ones to build a true kind of cross-margining engine in crypto. So usually if you want to go in and take margin on an exchange, you use either Bitcoin or cash. And they made a system where you could come with basically any crappy asset, honestly, or 50 different crappy assets, some of which were pretty crappy, deposit them on the platform and then go do all sorts of, hot deposit Solana was one they use a lot of, and then with that as your asset base, go in and speculate on, Ethereum futures and all sorts of weird financial instruments and perpetual futures. Like you do all this kind of crazy stuff. And they said they had this insanely intelligent system that could manage all these things. You'd have 30 trades all off of one collateral pool, and it would keep it all straight. As all the market in a really volatile market. And the answer was they didn't. Binance and Deribit had announced they were trying to work on the exact same thing for a while, and they haven't been able to launch it yet. It's actually really, really hard technically to do. There's just so many variables, and after prices move, and you have to assume these assets have varying levels of liquidity all the time, and it's hard to pull price oracles in crypto sometimes when the market is going really, really crazy. And people can take advantage of you if you don't do proper price oracles. How FTX lost a lot of money. They'd allow you to use a small coin, one example. Small coin is your collateral. Well, people realize, okay, that coin's only traded on 3 exchanges, and 2 of those are tiny exchanges. So I'll go, buy a ton of that coin on those 2 small exchanges. The price goes up 5x. And because only one big exchange had it, that one doesn't move. They look at them all equally. This was the most common trade against FTX. And then I can use that, and now I've got 5 times the collateral I should have. So I can take cash out and then let the price collapse, and I'm gone. Whatever. I took all the money out. So there's a lot of trades like that. So that's what really destroyed all the money in FTX. Every time, people were just arbing the crap out of themselves. in those kind of fashions. And they didn't have a way to stop it because they didn't have the engine. It didn't actually work. It was just humans. So Binance doesn't do that. Coinbase doesn't do that. Binance and Coinbase also don't have Alameda, the finance arm, the private equity arm that was sitting next to it that they would be funneling all the money back and forth to. So the opportunities for massive losses are way less at Binance. Binance is a pretty vanilla exchange, honestly. When they have payments, they built a lot of stuff, but you can't do very financially risky things on Binance. You can deposit one token and take 20x leverage, but it's only one token, so it's really easy to monitor that. If that one token goes down in value 5%, they liquidate you, or 4.5%. They give themselves a cushion, and they're the biggest exchange in the world. So there's no chance in my mind that Binance lost money the way FTX lost most of the money, and they don't do directional bets. Like they don't have a hedge fund attached to them that's out there just punting and arbing and taking all these weird bets that sometimes go wrong. So I'm pretty highly confident. I would have said 100% confident prior to FTX. Binance is just fine. I'm still 99% confident Binance is just fine. Now, having said that, we do trade on Binance. We keep like an hour's worth of assets there and take it off. So if we need to trade, Bitcoin for a client, we'll put on, $50,000 of Bitcoin. If we want to trade like $1 million, we'll put on, well, $1 million's not that much in Binance world, but anyway, we'll put on the coins, we'll trade it, we'll get it off within an hour, and we just keep our exposure really, really limited. So at any point in time, we have close to zero exposure.
David, thank you so much. Unfortunately, we are out of time, but thank you for all of the valuable insights you provided. To the audience members, we did make a recording of this. We will send it out to you. I apologize we were not able to get all of your questions, but please do email us if you do come up with another question or comment or just want to reach out to us. Our email is info@wavegp.com. Thank you again. And David, is there any last minute word you want to say?
No, thank you. Really appreciate giving all this time. Everyone knows in this company, I love to talk about crypto. So this is fun for me, but we'll hopefully do these a little more often and see everyone next time.
Yes, thank you so much.
Bye.